Warren Buffett dumped $143 billion in publicly traded equities in 2024. Bank of America alone saw 427 million shares sold. Not trimmed, sold. This isn't portfolio rebalancing. This is the most important risk signal in modern banking history. And almost nobody is paying attention to what it actually means. The number that matters isn't what Buffett sold. It's what the banking system is holding. $483 billion in unrealized securities losses as of December 2024. That number jumped $118 billion in a single quarter. Not because of some exotic derivatives crisis or subprime mortgages, because of treasury bonds and government-guaranteed mortgage-backed securities, the safest assets banks are supposed to hold. Let me make this concrete. An unrealized loss means you own something that's worth less than what you paid for it, but you haven't sold it yet, so the loss isn't real on paper. Think of it like owning a house you bought for $500,000 that is now worth $400,000. You haven't lost money until you actually sell it. But if you suddenly needed cash and had to sell tomorrow, that $100,000 loss becomes very real, very fast. Banks are sitting on these kinds of losses, but in their case, it's not houses. It's the safest government bonds you can buy. And they're underwater by nearly $500 billion. The accounting rules let them pretend this doesn't exist until the moment they actually need the money. Here's what the public sees. Buffett taking profits at high valuations, tax optimization, standard billionaire portfolio management. But that surface story ignores what happened in the mechanics. The timing tells you everything. He didn't start selling when Bank of America hit all-time highs. He started selling in July 2024, precisely when the 10-year Treasury yield began climbing back toward 4.6%. That's not profit-taking. That's exit velocity before the liquidity window closes. I'm going to walk you through exactly how this works, not the headline version, the balance sheet version, the liability side of the equation that determines whether a bank survives or enters receivership. By the end, you'll understand why Buffett isn't worried about Bank of America's loan book or their earnings. He's worried about duration risk, deposit flight, and the moment when mark-to-market becomes realize the loss. I spend a significant amount of time tracking institutional flows, not what funds say they're doing, what they're actually doing. Position changes, collateral postings, margin calls that don't make the news. The information is all public if you know where to look. What matters isn't individual trades. It's when the smart money moves in unison without coordination. That's a systemic tell. And right now, every major allocator who understands bank balance sheets is reducing exposure to regional financials while increasing treasury bill positions. That's not a trade. That's preparation. Let me explain one term that matters more than any other right now: duration mismatch. In plain language, it is the gap between how long your assets are locked up and how fast your liabilities can disappear. Here's how this works in practice. Imagine you run a business where people can give you money anytime and ask for it back tomorrow. That's your liability, the money you owe them. Now imagine you take that money and lock it into investments that don't mature for 30 years. That's your asset. As long as people don't ask for their money back all at once, you're fine. You can pay the few who withdraw from the money that's still coming in from new deposits. But what happens if everyone suddenly wants their money back at the same time? You can't get your money out of those 30-year investments without selling them early. And if you have to sell early, you might have to sell at a loss. That's duration mismatch. A bank borrows short and lends long. That's the fundamental business model. Depositors can withdraw money tomorrow. Mortgages don't mature for 30 years. As long as depositors stay calm and interest rates stay stable, this works. But when rates move fast, the assets lose value while the liabilities stay at par. The bank becomes insolvent on a mark-to-market basis, even though the income statement looks fine. Here's the official story you'll hear. Banks are well capitalized. Unrealized losses are just paper losses. As long as they hold securities to maturity, there's no actual loss. Liquidity coverage ratios are strong. Stress tests show resilience. The system learned from Silicon Valley Bank. Everything is fine. That's not what actually happened. What happened is the Federal Reserve raised rates faster than any time in 40 years, then started cutting just as long-term rates spiked again. The yield curve inverted, then steepened, then inverted again. Every single one of those moves destroys value in fixed-rate securities portfolios, and banks loaded up on those portfolios in 2020 and 2021 when the Fed was printing money and deposit inflows were massive. They bought long-duration assets at near-zero yields because loan demand was weak and they needed to deploy capital somewhere. Those same securities are now worth 70, 80 cents on the dollar. But they're marked at par on the held-to-maturity book. The loss is real. The accounting just doesn't show it yet. Let me break down how the system normally works. This is important. Stay with me. Layer 1. A bank takes in deposits. Those deposits are liabilities. The bank pays interest on them. Not much, but some. Layer 2. The bank deploys those deposits into assets, loans and securities. Loans are illiquid but profitable. Securities are liquid but lower yielding. The securities act as a buffer. If deposit outflows accelerate, the bank sells securities to meet withdrawals without touching the loan book. Layer 3, the securities portfolio is split into two categories: available for sale, where losses flow through equity immediately, and held to maturity, where losses are invisible unless the bank is forced to sell before maturity. Think of this like two different ways of keeping score. If you mark something available for sale, you have to admit what it's worth today, even if that's less than what you paid. It's like checking the value of your stock portfolio every day and updating your net worth accordingly. But if you mark something held to maturity, you get to pretend it's still worth what you paid for it, as long as you promise not to sell it before it matures. It's like saying your house is still worth $500,000 because that's what you paid, even though comparable homes are selling for $400,000, and you're planning to stay there forever anyway. Most banks shifted assets into held to maturity during 2022 and 2023 to avoid recognizing losses. That works until it doesn't. The moment you need cash and have to sell those held to maturity securities early, the invisible loss becomes very visible, very fast. Layer 4. Regulatory capital is calculated using book value, not market value. So a bank can be technically well capitalized according to regulators, while being economically insolvent if forced to liquidate. The gap between regulatory capital and economic capital is where the risk lives. Layer 5. The entire structure depends on confidence. Deposits don't leave. Liquidity doesn't dry up. Markets stay orderly. The moment confidence breaks, all 5 layers collapse in sequence. The assumption that broke is the one nobody wants to name. The assumption is that long-term interest rates would stay low forever, or at least decline after the Fed finished hiking. That assumption was everywhere: in bank asset liability models, in duration hedging strategies, in deposit beta assumptions. The entire post-financial crisis banking model was built on structurally low rates. Not temporarily low, structurally low, and that assumption is now wrong. 10-year Treasury yields hit 4.57% in December 2024. They fell briefly in Q1 2025, giving banks a $70 billion reprieve in unrealized losses. Then they climbed right back. As of today, we're approaching 4.6% again. If yields hit 5%, and there are multiple scenarios where they do, the aggregate unrealized loss across the banking system approaches $600 to $700 billion. That's more than the entire common equity tier 1 capital of mid-sized and regional banks combined. This is where the math breaks. Let me walk through the scenario. Start with a regional bank. $10 billion in total assets, $7 billion in deposits, $2 billion in equity. Securities portfolio of $3 billion, split between treasuries and mortgage-backed securities, purchased at an average yield of 1.8% during the pandemic. Current market yield, 4.3%. The duration on those securities is roughly 8 years. And when yields rise by 2.5% on an 8-year duration portfolio, the price falls by approximately 20%. That's $600 million in unrealized losses on a $3 billion portfolio. Let me explain why this happens, because it's counterintuitive if you're not familiar with how bonds work. When you buy a bond, you're buying a stream of future payments. If you bought a bond paying 2% interest, and then new bonds start paying 5% interest, nobody wants your old 2% bond anymore at the price you paid. They can get better returns elsewhere, so if you need to sell your bond, you have to sell it at a discount. The longer until your bond matures, the bigger the discount. That's why an 8-year bond loses about 20% of its value when rates jump 2.5%. The math is mechanical, unavoidable. Now, mark that to market. The bank's $2 billion in equity becomes $1.4 billion. The capital ratio drops from 20% to 14%, still solvent, still above regulatory minimums, but now visible to depositors, analysts, and counterparties. To clarify what equity and capital ratios mean, think of equity as the cushion that absorbs losses. If you own a house worth $400,000 and you have a $300,000 mortgage, your equity is $100,000. That's your cushion. If the house value drops to $350,000, your equity drops to $50,000. You're not bankrupt, but your cushion got a lot thinner. For banks, the capital ratio is how much cushion they have relative to their total assets. A 20% capital ratio means for every $100 in assets, the bank has $20 of its own money and $80 of borrowed money, mostly deposits. When losses hit, that $20 cushion absorbs them. If the cushion drops to $14, the bank is still solvent, but it's getting uncomfortably close to the point where regulators step in. Regulatory minimums are typically around 8 to 10% depending on the bank's size and risk. So at 14%, there's still room, but not much. Depositors start asking questions. 10% of uninsured deposits leave. That's $400 million. The bank needs liquidity. It can't sell the securities without realizing the loss and triggering a capital shortfall. It goes to the Federal Home Loan Bank for advances. That works, for now. Quick clarification here. Uninsured deposits are any deposits above $250,000 per account. If you have $1 million in your checking account, only $250,000 is insured by the FDIC. The other $750,000 is at risk if the bank fails. Business accounts, payroll accounts, municipal accounts, these are almost always above the insurance limit. These are the deposits that run first because the people and companies holding them are sophisticated enough to know they could lose money and they're watching closely. When they start pulling money out, that's when the bank runs into trouble. But borrowing from the FHLB signals distress. More depositors leave. Now 20% of uninsured deposits are gone. The bank has to sell securities. The moment it does, the loss becomes real. Equity falls below regulatory minimums. The FDIC steps in. The bank doesn't fail because of bad loans. It fails because of treasury bonds. Here's the critical point. This doesn't require fraud. It doesn't require a bad management decision. It doesn't even require unusual economic stress. It only requires depositors to notice what's already on the balance sheet. Liquidity collapses are nonlinear. They don't move in a straight line. They move in phases. Phase 1, quiet exits. Sophisticated depositors with uninsured balances move money to larger banks or money market funds. No headlines, no panic, just prudent risk management. Phase 2, visible outflows. The bank's liquidity coverage ratio drops. Funding costs rise. Analyst downgrades begin. Phase 3, acceleration. Social media posts, news articles, depositor panic, the classic run. Phase 4, failure or intervention. Think of it like a bar that's over capacity. Everyone knows it's crowded, but as long as nobody moves toward the exit, it's fine. You can't all leave at once, but you don't need to, because you're not all trying to leave at the same time. The building is safe. The drinks keep flowing. Everything works. But the moment someone yells fire, real or not, everyone moves at once. Now the door becomes a choke point. It doesn't matter if there's actually a fire. It doesn't matter if the building is structurally sound. What matters is that 200 people are trying to get through a door built for 20 people at a time. People get hurt, not because there wasn't enough space in the building, but because there wasn't enough space in the exit at the moment everyone needed it. Liquidity works the same way. There's enough money in the system. Banks collectively have trillions in assets, but there's not enough money at the withdrawal window when everyone shows up at the same time demanding cash. The ATM can only dispense so much. The wire transfer system can only process so many transactions. And if the bank has to sell its bond portfolio to meet withdrawals, it has to find buyers. And buyers know the bank is desperate, so they demand discounts. The exit gets narrower exactly when you need it to be wider. The feedback loop is what kills you. Falling asset prices force selling. Selling creates more price decline. Decline triggers more withdrawals. Withdrawals force more selling. Once it starts, it doesn't stop until something breaks or someone intervenes. Silicon Valley Bank went from solvent to insolvent to receivership in 48 hours. Not 48 weeks, 48 hours. That's the speed at which liquidity crises move in the digital age. We're now living in two parallel realities that haven't collided yet. Reality 1, regulatory filings show well-capitalized banks with strong earnings and manageable risk. Reality 2, market pricing shows a banking system sitting on $500 billion in embedded losses that become real the moment they need liquidity. The gap between those realities is the spread between book value and market value. Book value is what the accountants say something is worth based on the rules. Market value is what someone will actually pay for it today. It's the difference between what assets are marked at and what they're worth if you have to sell them tomorrow. Here's a simple example. You own a car you bought for $30,000 2 years ago. In your personal accounting, you might value it at $25,000. Assuming normal depreciation, that's book value. But if you desperately need cash today and have to sell it within 24 hours, you might only get $18,000 because buyers know you're desperate and the market for quick sales is thin. That's market value. The difference between $25,000 and $18,000 is the gap we're talking about. For banks, that gap is currently $500 billion. In calm markets, that spread doesn't matter. Banks don't need to sell. In stressed markets, it's the only thing that matters. You saw this exact divergence in March 2023 with Silicon Valley Bank. The balance sheet looked fine on paper. 93% of deposits were uninsured, but the capital ratios were adequate. The moment they announced a securities sale to raise liquidity, the market repriced their equity to zero in 72 hours. The paper reality and the market reality collided. The market reality won. What happened was this. Silicon Valley Bank had to sell some of its bond portfolio at a loss to raise cash. When they announced that sale, everyone did the math. If they're taking losses on the bonds they sold, that means all their other bonds, the ones they're still holding, are also sitting at losses. Depositors, especially the venture capital firms and tech companies that made up most of their customer base, realized the bank might not have enough equity to cover all the losses if everyone withdrew at once. So they withdrew, not over weeks, over hours. By the time regulators stepped in, $18 billion had left in a single day, and another $100 billion was queued up to leave the next morning. The bank failed not because it made bad loans, but because it held treasury bonds during a period of rising interest rates, and depositors figured it out faster than the bank could react. That's how fast modern bank runs happen. Right now, the same divergence exists across dozens of regional banks. The paper says solvent, the market says fragile. At some point, these two realities converge. They always do. The question is, what triggers the convergence and how fast it happens? There are three possible outcomes here. Let me assign rough probabilities. Outcome 1, rates fall sharply and stay down. The Fed cuts aggressively. 10-year yields drop below 3%. Unrealized losses shrink. Banks gradually work through the duration mismatch. Confidence stabilizes. Probability 15%. This requires a significant economic deterioration that forces the Fed into panic mode, and even then, long-term rates might not cooperate. Outcome 2, targeted failures and emergency liquidity. A handful of regional banks fail or are forced into mergers. The FDIC steps in. The Fed opens emergency lending facilities. Uninsured depositors take haircuts or get bailed out depending on political pressure. The system absorbs the losses but remains unstable. Banks pull back lending. Credit tightens. Economic slowdown follows. Probability 60%. This is the managed decline scenario, controlled chaos. What this looks like in practice: you wake up one morning and see news that 3 or 4 regional banks have been seized by regulators over the weekend. If you're a customer of one of those banks, your insured deposits are fine. You can access them Monday morning, probably through a larger bank that acquired the failed one. But if you had $1 million in that bank, you might only get back your insured $250,000 immediately. The rest gets tied up in receivership for months or years, and you might eventually get 70 or 80 cents on the dollar. For everyone else, even if your bank is fine, you'll notice credit getting tighter. Business loan applications take longer and get rejected more often. Mortgage rates stay elevated even if the Fed cuts rates, because banks are scared and pulling back. The economy slows down not because of a recession in the traditional sense, but because the financial plumbing isn't working as smoothly. This scenario is painful but manageable. It's what happened in the regional banking crisis of the 1980s and early 1990s. Outcome 3, widespread panic and systemic intervention. Multiple large regional banks face simultaneous runs. The contagion spreads to larger institutions. The Fed has to guarantee all deposits, not just insured ones. Emergency monetary policy follows. Massive liquidity injections. The banking system survives, but trust in the dollar takes a hit. Probability 25%. This is the tail risk that becomes the base case if rates spike above 5% and stay there. In this scenario, it's not just 3 or 4 small banks. It's 10, 15, 20 banks, including some you've heard of. Names with branches in every state. The contagion spreads, because once people see banks failing, they start questioning all banks. Even healthy banks face runs because depositors can't tell the difference between a bank with problems and a bank that's fine, so they pull money from both. The government steps in with emergency measures. The FDIC announces that all deposits, not just the first $250,000, are guaranteed. The Federal Reserve prints however much money is needed to keep the system liquid. ATMs keep working. Direct deposits keep hitting. But in the background, the government just backstopped trillions in deposits, effectively nationalizing the risk. The banking system doesn't collapse, but confidence in the currency takes damage. People start questioning whether dollars are really worth what they used to be when the government can just create unlimited amounts to solve problems. This is the 2008 scenario, but potentially larger because the unrealized losses are in the safest assets, government bonds, not subprime mortgages. It's survivable, but it changes the game long term. None of these are good. The first is unlikely. The second is painful. The third is catastrophic. And Buffett is betting we're somewhere between 2 and 3. What this means for you is not panic. It's clarity. Do not run to your bank and withdraw everything tomorrow. That creates the problem you're trying to avoid. The vast majority of banks will be fine. Deposit insurance covers $250,000 per account. If you're above that limit, spread your deposits across multiple institutions, each under the insured limit, or move excess funds into Treasury money market funds. Let me explain what those are. A Treasury money market fund is essentially a mutual fund that only buys short-term U.S. government debt, Treasury bills that mature in days or weeks, not years, because they only hold government securities, and because those securities are very short-term, there's almost no price risk. The value stays stable at $1 per share. You can get your money out same day or next day. And because it's backed by U.S. Treasury securities, it's as safe as anything can be in the financial system. You're not lending to a bank anymore. You're lending to the U.S. government. Your bank could fail. The U.S. government, at least in dollar terms, won't. That's the difference. But understand what you're watching. This is not about individual bank quality. This is about system design. The banking model that worked for 40 years under declining rates does not work under rising or volatile rates. The entire architecture is built on an assumption that no longer holds. And the adjustment process, when it comes, will not be smooth. Here are the indicators to watch, not every day. Once a week is enough. 1. The FHLB advanced data. When banks borrow heavily from the Federal Home Loan Banks, it signals liquidity stress. Let me explain what this means. The Federal Home Loan Bank system is essentially a lender of second-to-last resort for banks. It's not the Federal Reserve, which is the true lender of last resort, but it's close. When a bank can't get funding from normal sources, depositors, other banks, the regular markets, it can go to the FHLB and borrow money by posting collateral. This is legal, normal, and happens all the time at low levels. But when borrowing from the FHLB spikes suddenly, it means banks are struggling to fund themselves through normal channels. It's like someone maxing out their credit cards, not because they want to, but because they can't get cash any other way. One bank doing this might be fine. Many banks doing this at once is a red flag. That data is public and updated quarterly, but sharp increases show up in weekly aggregates. 2. Uninsured deposit flows. The FDIC publishes this quarterly. If you see accelerating outflows from regional banks to large banks, that's sophisticated money moving. 3. The 10-year Treasury yield. If it breaks above 4.75% and holds, unrealized losses are growing. If it breaks 5%, we're in the danger zone. 4. Credit default swap spreads on regional bank debt. When the cost of insuring against default rises, the market is pricing in higher risk. Think of this like earthquake insurance for your house. If you live in California, earthquake insurance costs more than if you live in Ohio because the risk is higher. Credit default swaps are insurance contracts on debt. If a bank's debt becomes riskier, the cost to insure against that bank defaulting goes up. When you see those insurance costs rising, it means the smart money thinks the risk is increasing. This is publicly available data, though you typically need financial data services to track it easily. The key point, rising insurance costs mean rising risk, as judged by people who are literally betting money on the outcome. You can track this through financial data terminals or aggregated indices. 5. Analyst downgrades and equity price action in regional financials. Markets see stress before regulators do. Falling stock prices in banks with large securities portfolios are a leading indicator, not a lagging one. You don't need to be a trader. You don't need to obsess. You just need to be aware that the stability you see in your checking account balance is backed by a system that's holding losses it hasn't admitted yet. Zoom out for a moment. This isn't just about banks. This is about the end of a 40-year cycle. Interest rates fell from 15% in 1981 to near zero in 2020. Every financial institution, every pension fund, every insurance company, every business model was built assuming that trend would continue or at least stabilize at low levels. Now rates are structurally higher. Not catastrophically high, just higher. And higher is enough to break things that were designed for lower. To put this in perspective, in 1981, if you wanted to borrow money to buy a house, mortgage rates were 15%. By 2021, they were under 3%. That 40-year decline meant that debt kept getting cheaper, asset prices kept rising, and financial engineering kept working. Companies could borrow cheaply to buy back stock. Governments could borrow cheaply to fund deficits. Individuals could borrow cheaply to buy homes and cars. The entire economic model of the last generation was built on ever cheaper money. Now rates are back up to 4, 5, 6%, depending on what you're borrowing. That's not 1980s levels. It's not a crisis rate. But it's high enough that all the strategies built for a low-rate world stop working. And banking, more than almost any other industry, was optimized for low rates. That optimization is now the vulnerability. The banking sector is the most visible stress point because banks have the most duration risk and the least flexibility. But the same dynamic is playing out in commercial real estate, in pension liabilities, and government debt sustainability. The whole architecture of modern finance was built on cheap money. That foundation is shifting. And Buffett knows this. He's not selling because Bank of America is a bad company. He's selling because the environment that made Bank of America profitable is ending. The carry trade that defined banking for a generation, borrow at 0 and lend at 3, does not work when you're borrowing at 2 and your loan book is yielding 1.5 because it was originated years ago. The math stops working. And when the math stops working, the model breaks. Let me break down what that carry trade means in simple terms. For 40 years, banks could borrow money from depositors at very low interest rates, sometimes close to 0%, and then lend that money out in mortgages and business loans at 3, 4, 5%. The difference, the spread, was their profit. If you borrow at 0 and lend at 3, you make 3% on every dollar. That's a great business. But now, depositors want higher interest rates because they can get 4% in a savings account at an online bank or in a treasury bill. So the bank's cost of funds went from 0 to 2%. Meanwhile, the loans the bank made 5 years ago are still only paying 1.5%, because those are fixed rate loans that don't change. Now, the bank is paying out more in interest to depositors than it's earning from old loans. The carry trade inverted. Instead of making money on the spread, they're losing money. That's not a sustainable business model. The question is not if this resolves. It will, either through rate cuts, bank failures, mergers, regulatory forbearance, or some combination of all four. The question is not if. The question is how long the system can maintain the fiction that unrealized losses don't matter, and what the price will be when that fiction ends. Buffett just told you his answer. $143 billion in stock sales, 427 million shares of Bank of America. Not because he thinks the market will crash tomorrow, because he thinks the risk reward has fundamentally shifted, and the margin of safety that made banks attractive investments 5 years ago no longer exists. You can choose to believe the regulatory filings and the earnings calls and the analyst upgrades, or you can choose to believe the man who has been right about banking crises more times than anyone alive. I know which signal I'm following, and so should you.